name is Michael Elliott, Equity Research Analyst here at CFRA Research. I'm excited to talk to everyone today about real estate, and specifically publicly traded REITs, and why we think the power of sub-industry selection matters. Our quick disclaimer. Now our agenda. So we're going to start by talking about CFRA's sub-industry overview. This will be a quick table just giving you a high-level view of our thoughts on the sector. Then we'll talk about property type growth and balance sheet metrics before moving into some key sub-industry outlooks. Then we'll discuss sub-industry performance valuation and why we think the variation in returns presents opportunities for investors. Finally, we'll discuss post-hike rate pause performance and what those trends have looked like since before the Great Financial Crisis. On CFRA's sub-industry outlooks, breaking down REITs by sub-industry can help generate alpha opportunities for investors in our view. As you can see, this is not an encompassing list of all the sub-industries of real estate, but we do think it covers all the major types. You can see we currently have 4 positive views and 2 negative views, and you also see we've listed some economic cycle style as well as current leasing environment trends. Hopefully this can give investors a good view of how we view the sector and some of the high-level properties of each sub-industry. On real estate fundamentals, we think balance sheets are going to be very important to focus on as we head towards 2024. With rates likely to be higher for longer, REITs that currently have a lot of short-term debt that needs to be refinanced or variable rate debt will feel the brunt of the current rate environment. So with that being said, you can see industrial and self-storage very well positioned with high interest coverage and low short-term debt. Conversely, you can see hotel and resort REITs, which are struggling with a combination of high variable rate debt, high short-term debt, and low interest coverage. Office REITs have higher short-term debt, but modest interest coverage levels. However, we think there's a lot of headwinds ahead for the sector. Looking at implied cap rates can also give us a view of how investors that are transacting on these properties view each sub-industry. Looking at this, we also see industrial and self-storage as pretty in favor of property types, while office and hotel and resorts are out of favor. Now to dive a little deeper into the sectors we view positively. These are data center, healthcare, industrial, and self-storage. On data center, we think demand is going to remain elevated as data usage keeps increasing and should for the foreseeable future. This will continue to drive demand for data centers. Furthermore, supply constraints are starting to form as power usage is very tough to come by in many of the main markets where data centers are present. As a result, we think demand is going to remain elevated, while supply could be slightly constrained, leading to positive pricing power for data center REITs. AI could add another potential catalyst for the sector, as a lot of model trading occurs within data centers. On healthcare, we think this is really a post-pandemic recovery story at an inflection point. Growth is returning to the industry, especially within senior housing, and only moderate debt levels are being observed. Positive demographic trends, such as an aging population and higher medical spending, are also going to accelerate and help this sector, while the defensive nature can provide investors some protection if we head into a recession in the next 6 to 12 months. On industrial, we think balance sheets remain really strong, and despite the typical cyclical nature of the industry, they should be poised to perform well over the next 12 months or so, regardless of if we see a recession or if the economy keeps remaining resilient and humming along. E-commerce remains a long-term secular driver in our view and is again starting to take share from brick and mortar after you saw a slight reversal following the pandemic. Further, we think demand and supply come back into balance in 2024 after record new supply growth in 2023 has led to slightly rising vacancy rates. Finally, on self-storage, the pandemic fueled additional catalysts for the sector as many people were relocating, and you also had new work from home trends that led to people needing more office space and therefore more space to store other things. While relocating is not going to pick up likely in the next few years with really high mortgage rates, we do think work from home could be a long-term positive catalyst for this sector. Further, we see modest new construction in the pipeline, leading to low risk of oversupply, while a lot of industry consolidation has been occurring, which will benefit these large publicly traded REITs, which benefit from economies of scale. On to our negative outlooks. We currently have negative views on office and hotel and resort real estate. Office REITs have been struggling due to work from home and hybrid work trends, which are likely to provide long-term secular headwinds. Also, they do have a significant amount of short-term debt, which will be difficult to refinance at higher rates and because of lower property values. Conversions of Class B and C type office space, while popular to hear about, are much easier said than done. It can be very difficult to get, the types of regulations needed for the type of residential conversions, and sometimes it can be just hard to get the buildings cleared. If there's only 2 tenants in a building, you either have to buy them out or you have to wait for those leases to expire. This all makes it harder to convert office space to other uses. On hotel and resort, they already have pretty poor metrics from a balance sheet perspective compared to the rest of the sector, as we saw in the table a few slides previously. However, we also see more headwinds as leisure travel, which has been robust post-pandemic, likely reverts to more normalized trends in 2024, partially as consumers spend down their savings and also as a potential recession weighs on the sector. Business travel also remains well below pre-pandemic averages, and we think it will continue to do so moving forward as teleconferencing replaces many in-person meetings. Now we want to move on to our sub-industry selection, and this chart you see on the left will really lead to why we think the power of sub-industry selection is very important for investors. The chart on the left shows the dispersion of returns from 2018 to 2023 on a yearly basis across the sub-industries we're covering. As you can see, there's significant variation in returns on a yearly basis for those sub-industries. In fact, since 2018, the average annual variance between the best and worst performing REIT sub-industries in a given year is 39%. As a result, we recommend investors start their REIT analysis by evaluating these sub-industries. Once they evaluate these sub-industries and take views on which ones are more likely to perform positively or negatively over their given time horizon, we think they can then go and do further analysis, whether it's bottoms up or any other sort needed to determine which sectors or which companies are best to allocate their resources to. Finally, we want to discuss the Fed pause. REITs are very sensitive to higher interest rates, as you probably know, and as a result, this current rising rate regime has been very difficult for the sector. However, with a pause on the horizon, we see a potential catalyst. The chart below shows rate pause regimes from June 2006 all the way up to the most recent one, which is March 2022. As you can see from this chart, industries such as industrial, residential, retail, and self-storage REITs were the best performing during the last 4 pause cycles, outperforming the FTSE Nareit Index in 3 out of the 4. On the other side, office REITs were the worst performing, underperforming their broader REIT peers across all pause cycles. This doesn't bode well for a sector that, as you can see in the far right, is down 50% since the start of the last tightening cycle, as rates have been increasing. Thank you very much for your time, and I hope you learn more about the publicly traded REIT sector and our views on why sub-industry selection matters. Have a good day.